Today what we're going to do is, what do we put on the screen about? That's it. I wish there'd be more there, but that's actually just it. Okay, so today we're starting chapter 6. The reason we're skipping, excuse me, chapter 5. Chapter 5 is kind of really deep. You can look at it if you want, but it's really detailed about sales and purchases and all that kind of stuff. We might come back to it, but quite honestly, it's kind of, my hair is like, it looks like it's wind blown. It's kind of detailed. Well, first of all, it's a lot more journal entries, but second of all, it's a pretty detailed chapter on kind of small stuff, and it really should come after chapter 6, anyways. We'll probably skip it for a little longer than that, but just the nature of it. Chapter 6 is on the cost, the cost of inventory, and so chapter 5 doing the journal entries for it. Kind of a little, sort of ahead of time. If you don't know the cost, it's hard to make a journal entry for it. But okay, so we're going to do start on chapter 6, and chapter 6 is all about when you sell something. When you sell whatever it is, if you sell if you're a retail business, you're selling merchandise. So kind of up to this point, we've been focusing on things that were services. Lawn care and consulting and construction and things that are mostly services. You're doing a service for somebody. Whereas now we're going to talk about when you sell something. And the idea is you buy something and then you sell it for more. That's really it. That's all there is to kind of retail, merchandising. And that's true whether you're selling cars, whether you're selling donuts, whether you're selling, whatever it is, that you buy it for less and then sell it for more. Okay, so I'm going to sell this little toy car for $10. And I paid $6 for it. So I paid $6 for it. I sell it for $10. How much am I making on it? I know you guys know this. You're just toying with me. You can put it in chat if you want.
$4.
Yep. Yeah, I made $4. So it's pretty easy. It's pretty obvious, right? I mean, if I bought it for $6, sold it for $10. Okay, so now what happened though? Someone gave me $10. Now this car is leaving with whoever bought it, right? So I gave up a $6 car. Now I'm glad I got $10, but I gave up the $6 car. That car is gone. It's not coming back. I can't sell that car again, right? And so this is kind of how this would look like in what we're doing today. To put it into, I'm not showing you my screen. You have no idea what I'm doing. Let's try that again. So if I sell a toy car, it costs $6 for $10. This is what this would look like. I'd have a sale. say sales of $10. Now that wouldn't be all profit, obviously, because I paid $6 for the car. Oh, actually, I moved my camera. That's why I'm getting it funny. This is another camera, by the way. I could use this one. What I have to do subtract off is what I paid for that car in the first place, right? Because that car just left. I don't have it again. So the cost of goods sold, which is longer than I thought it was going to be. And we would have a gross margin or gross profit. I use gross margin. Gross margin, gross margin, gross profit, the same thing would be $4. So this is how that sale would actually look on the income statement. I have a sale of 10, but that's not all profit because I paid $6 for this, and it's gone. So I can't sell it again. So I gave up a toy car for $6. So I made $4 on it. So this is kind of how it would look in our financial statement. The sale would be 10. What I sold and what it cost, what the car cost was was $6. And so I made $4 on the sale. I have $4 of profit, basically. And this is kind of the whole thing about inventory that we're going to go through is that you have a sale, and inventory leaves the place, and it's not coming back. I can't sell this car again; it's gone. Whoever bought it walked out the door with it. So you can only sell things once. And it's the cost of goods sold. I don't know if you remember from the financial statements. I said it's kind of like an expense. It's not actually cash going out. It's it's merchandise going out. But the same thing. This is a $6 asset. This $6 the cost on this thing, and it left. So similar to an expense, it went out the door. It's not cash going out the door, but it's an asset going out the door. And so what I'm left over with is the $4. Okay, so that's kind of the whole idea behind it. All right, let's go to the handout. Now, is there anyone that does not have the handout? I think it's in Blackboard. Oops, that's my mail. Oops, that shouldn't be up either. Course files. Man, there's a lot of. I sent you guys a lot of stuff. I'm like halfway through. All right. Yeah. Chapter 6 is there. So anyway, if you don't have it, it's in files. Okay. So this is kind of what we're going to be doing now for this chapter, and it's it's basically just you're selling something. So here's our sales. We sold 160 units. Now these are the units that we have in stock. This is our beginning inventory. It was the inventory we started from. I'm going to change cameras here so I can get the calculator up. You get to see doggy. Doggy. All right. So this is what we sold. We sold 160 of them for $15 each. Here's our inventory. We start out with 100 and we purchased 130. Here's a question for you. Do we sell all of our inventory?
Yeah.
Actually, we didn't. We sold 160 of them. If you add these up, it comes up to, what is that,
230?
Yeah, it's 230. So this is going to be what our available. You don't need to write this in. This is what our available would be. 230. So we didn't sell all of it. So we're still going to have some inventory left over. After we sell, which is good, right? Probably good. You don't want to go down to zero, then you have nothing to sell. People walk in your store and turn around and walk back out. So this is the inventory we have. We sold 160 of them. Did we make a profit on this? On these sales?
Yeah, they sold it for $5 extra from what they paid for.
Exactly. Yep. We sold them for 15. We only paid 10 for them, so we're gonna make $5 for exactly $5 profit on each one. Okay, so let's go to calculate the sales for January. I don't know why I put 3 lines here, but I did. So our sales will be units. We sold 160. And the selling price, I don't know if I fit in here. Oh, 1 letter short. Well, we'll make a little space here. All right. So 160 times the selling price was $15. That's going to equal. Where's it? 160 times 15 is 2,400. Let's better use the calculator. $2,400. So $2,400 came in. So that'd be our sales for January. There's maybe a dollar sign there. Okay, and the cost of goods sold. Well, we sold 160. Now, you might be tempted to put the 230 in there, but that's not what we sold. So the cost of goods sold, the important word there is what we sold. So these units are going to match up with these units, right? We sold 160, the cost for 160. So this is going to be your cost of goods sold. So this will be 160 times, and I'm going to make some space here because I know this is not going to, wait. The cost was, it'll fit, $10. So our cost of goods sold is $1,600. So this is the cash that came in. This is the inventory that left. Inventory that left the building. So we gave up $1,600 of inventory, which we're happy to do for $2,400. Okay, so calculate the gross profit. Okay, so we have sales. Cost of goods minus cost of goods sold. Oops. And that will give us our I use gross profit instead of gross margin. They're the same thing. I should put that in there. Give me 1 second here, though. Okay, so we sold 2,400. Our cost of goods sold, what left the place, cost us 1,600. And inventory is gone. It's never coming back. And so our gross profit is 800. Yeah. And just so you know, gross profit and gross margin are the same thing. I don't know why there's two terms. I don't know, but they both mean exactly the same thing. So this is going to be our gross profit. Our ending inventory. All right, our ending inventory is a little bit trickier because we had so we had available 230. We sold 160. So how much in inventory do we have left?
$70.
Yeah. Yep. So we had. Yeah, 230. We sold 60. So our ending inventory is 170. No, 70. Just 70. I'm sorry. So our ending inventory is 70. We paid, the cost was $10. So that's 700. So this is what would be on our balance sheet. Under assets or current assets. Where's my? Wish I could have this shapes thing up all the time. There probably is a way to do it. I'm sure there is. Okay, so we're going to have our inventory in our books, and it's going to be at. So we'll have our inventory on the books at 700. It's in our balance sheet. This stuff all up here will all go on the income statement. So this will be on the income statement. This down here will all be stuff on the balance sheet. So this is show that we made a profit of 800 in the income statement. This down here will be just inventory. I probably won't say ending, it's say inventory of 700. Now, here's the thing. This inventory of 700, this is the ending inventory. This is for January. So on February, this will become the beginning inventory starting the next month. like this. Stop sharing, which I don't like doing anyways. All right, so it's kind of like this. Need focus, doggy. Okay. Nice too. So here's kind of what is going on. We have the January. I gotta peek here. So in January we had beginning inventory of 100 units at $10 each. 1,000 are beginning inventory. During the month, we purchased 130. And at the end, our ending inventory, we had 70 at 10 or 700. Now, this ending inventory for January will become the beginning inventory for February. Yeah, so we had 70 at 10. So 700 inventory on January 31st. When we start into February, will become our beginning inventory in February, right? Because that's how much we had on hand on 131. So the next day we come into work, and that's our beginning inventory. And is what the ending was for the previous month. And, it keeps going on like that. We'll have some purchases here, which we don't know how much they are. We'll have the, ending inventory, whatever it is. And this ending inventory will become the beginning inventory in March. That's kind of, how I don't know what you call it, the logistics of it. Okay. Let's go to. Any question on this first one? If you have any question on the first one, please ask, because this is this is our new thing you guys probably haven't seen before. The idea of inventory is pretty intuitive. You buy it for less and sell it for more. That's kind of everything in business, right? That's how you make a profit. But the working it out can be a little bit tricky. Okay, let's go to number 2, and I think I'll be quiet for a minute or two and see if you guys can figure out. Do you have a question? Okay, so see if you can figure out the sales. By the way, the sales are pretty easy. Whatever you sold it for. These in here are going to be the ones that are going to be the tricky ones. I'm sorry. The available units were the same as before. 230. No, it's not always going to be like that. In fact, next time I make this handout, it won't be like that. But so we had 230 available. We sold 190. So how much is in our ending inventory?
40.
Yep. So we could have sold, the most we could have sold was 230. Again, that's an unhappy coincidence. Did this say sold? What am I doing here? I'm in the wrong one. Okay, I was just showing you what not to do there. So don't do what I just did. Okay, so this would be sales. Oops. We're 9,500. Our cost of goods sold, and these are, again, they're gone. They've left the place. They're not coming back. So $3,800 worth of the inventory left, not coming back. At least we hope it doesn't come back. Hope it's not as returned, but let's assume they're not going to return. So this would be our gross profit. Sometimes called gross margin, same thing. It is not spelled like that. 9,500 minus 3,800, whatever that is. 5,700. So this would be our gross profit for the place. We sold them for 9,500. We paid 38. So we lost 3,800 of inventory. We didn't lose it, but we sold 3,800 of inventory. It's gone out the door. We got in 9,500. So this is our gross profit for what we're selling those things. Okay, down here. This is where I was. Okay, we had available. $230. We sold. Oops. $90. So what's left our ending inventory. So this is what will be at. This will be what was on our books, on our balance sheet, I should say. At the end. 40. Yeah. $20 each? Yeah. $800.
And then inventory would be the asset on the balance sheet, you said?
Yeah. Yeah, our assets. Yeah, it actually in our current assets, but that doesn't matter right now. So this will be on the balance sheet. Under assets, not all places have classified balance sheets, so it could definitely be under just assets. Yeah, let's see the current assets out for now. We don't need to worry about that right now. So under assets, you'd have this inventory, and so in the inventory account, and then you'd also have it for $800. And this is the ending inventory in January. It would become the beginning inventory in February. This is as of, it doesn't say the year here, but 1/31. And so then when you go into February, when midnight passes, it goes to, it becomes the beginning inventory on 2/1. Any question on that? Okay. Now, for the difficult part, I gotta do something here. Yeah, I'm sharing the wrong way. Okay. You'll notice something on page 3, something that happened. I'll forget about all this stuff up here. What changed with our inventory on page 3? There's something.
There are 2 different prices for the units.
Yeah, the prices changed. Now, this happens, all the time in business. You order one price, the price goes up, it goes down, whatever it does. Now, here is the problem. My camera's not in the right spot. But a second problem, besides my camera not being in the right spot, is, okay, let's say that whatever we're selling is this car. What are we selling it for? $40. Selling it for 40. Okay, so so we sold it for 40. The problem is, which cost do we use? There's 2 different costs. And it makes a difference because we don't know how much profit we made on this thing. We know what we sold it for. The selling price is easy. Whatever, you handed it to them, whatever they gave you back, that's real easy. The cost is the hard part because there's 2 different costs. So the question is, well, which cost do we use? Because it's going to make a difference in 2 places. It's going to make a difference on our income statement for whatever the, whatever was the cost of goods sold that left. That'll make a difference. It'll make a difference in our income and our profit. It'll also make a difference on our balance sheet because whatever we didn't sell is going to have some cost. So it's really going to affect our income statement and our balance sheet to figure out which cost we use. The selling price, easy. Sold for $40. Yes. That's exactly right. But we'll calculate the cost and then add them up. Which ones? And then what we're going to do is there's actually 3 ways to do it. And maybe I should just go into those right now. Let me go here. Oops. So for our inventory, we're going to have 3 different ways of calculating it in this class. There's actually a lot of ways to calculate, but it's which one do I do first? Is it first in, first out? Okay. So first in, oops, first, out. My typing is not so good. And when we say that first in, first out, what we really mean is first. Oops. You know what? Copy this. What we really mean is this. Now it's called first in, first out, but it really is first in, first sold. So first in, first out. What we mean is first sold. This is usually called FIFO. We also have the last in, first out. That curiously, we only use it in America. It's called LIFO. And it means the last in was the first sold. And then lastly, average cost, something's called weighted average. You also just see it called average cost. The weighted is assumed. And that is where you add them all together, add all the costs together, and then divide into it. Now, as far as the different methods, first in, first out is one that probably makes theoretically the most sense. The first ones you got in and the first ones you're going to sell. Think of a grocery store, you know, the first milk that they get in, the first milk they're going to sell, you can't have milk sitting around for 6 months or something. So, you know, the first one's in, the first one's sold. Last one in is a theoretical one, which we'll talk about when we get to it. And then weighted average is one that was basically ignored until and I know it sounds strange, but they didn't have calculators really until you know, late 60s, 1960s. So weighted average, we have to calculate the average. Whenever you buy inventory, you got to calculate the average. It was just too cumbersome for the most part. Not even with computers, it's really, in fact, if you do computer programming, this one is the easiest to program. You just lump all the units, lump all the costs together, and the computer will, billionth of a second, will spit out what the average is. But these are the two that most companies use, and a lot of companies in the U.S. will actually use this in the last in, first out. You won't see any international companies using it because they can't. It's not allowed in international standards, but we do it in the United States. So these are the three methods we're going to do. And today we're going to do the first in, first out. Okay. So let's go back to our problem. Sales will be exactly the same as we did before. Sales are always real easy. Whatever, you know, you gave them the merchandise, whatever they handed you, that's the sales. Okay, so we have sales. Oops. 45. Price each was 40. So this is exactly like we did before. So 45 times 1,800. Okay, now come down here. We define the cost of goods sold for January. Now, first of all, we know we're going to be profitable on it because we sold them for 40, and you know, these are the two prices on it, so we know that we made money. The question is, how much do we make on it? Okay, so we sold And this is going to look a little bit funny. So we, oops, not net, need. We need to find the cost for 45 of them. Okay. So we're doing first in, first out method. Now, first in, first out really means first in, first sold. Okay.
So would you do it from the beginning inventory then?
Yep. Very good. So we sold from this beginning inventory, we had 80 units. These were the first ones in. These were in before the purchases, right? So these were in first. So we will take it from the 1-1. We can get all 45 units out of that beginning inventory, so we'll take all 45 at $22 equals something. $9.90?
Yes.
Okay. So this would be our cost of goods sold. I think I'm going to run into problems when I look at this. I got to figure out some way to do this. I should have another column. I know. I'll get it out of here completely. Okay, so I'm going to do it up here. So we need 45. Unit cost for 45 units, and we got all of those on 1-1. So we have 45 minus 45. So how many do we still need? It's gonna look stupid, but hey, I've been there before. Okay, so this is, so we don't need the cost rate. We got everything we need. We got from the first round of inventory. You can probably guess from why they did this that that's not going to be the case sometimes. You know, if we had sold, say, 100, we would have sold all 80 and then gone into this next round, right? This next layer. So sometimes you kind of have to keep track of how many you still need. So you start out with needing exactly what, you know, from the the number of units you sold is you still sold the same number. You know, the units aren't going to change. It's just the cost that changes in this one. Okay, so this will be our cost of goods sold. So if we're using this method, we know that the you know, we'll be able to tell what our profit's going to be. Okay, so down here, gross profit will be sales. 1800. That's not 1800. Okay. Our cost of goods sold. By the way, you'll frequently see this called COGS. My first auditing jobs, I kept talking about cogs. Now this is it was an engine assembly plant, so they didn't have cog, but you kept talking about cogs for. Then I realized you're talking about cost of goods sold. So anyway, I'm just sitting there confused for about a couple of minutes. Like, cogs. I know they're part of building an engine, but I didn't think that they would be a whole conversation. Okay, so let's be gross profit. $810, right? Minus $810. Okay, so the gross profit is going to be $810 now. Notice how that gross profit could have been different if we had used different ones that we sold, right? If we sold these, the profit would have been different. But so this is our gross profit. Ending inventory. Oh, I did some spacing stuff here. Okay, this is going to be a little bit tricky now. And here's why. It matters which ones we sold. Okay, so up here, this 80 units, do we still have 80 units in the beginning inventory?
No, it would be 35.
Yep. 45 of them were sold. And there needs to be a better way for me to do this. So this is what is left in that first row of inventory. So we have 35 at 22. We still have this 50 here. This 50 is still on the books. So we have 35 left from the beginning inventory. We have 50 left from the purchase on the 10th. And we got to keep track because these are at two different prices. So our ending inventory is going to be 35 at 22 and 50 at 25. And I wish there was a way I could split that so I can do it down here. So this is so and then we also have the inventory still sitting there. From 110. Just that quickly, I forgot what it was. 50 at 25. Okay. You know what I'm going to do? I'm going to copy this and I'm going to cut and copy it down here. Okay, so we have 35 at 22, and we still have 50 at 25. Okay, so whatever that is. 770? 770. Okay, so 770. We have 50 at 25. 50. So our ending inventory will be those two together. 2020. So this is our ending inventory. And that will become our beginning inventory. Fine. So this would be on our, need more space. And we're done up here. Okay, so this will be on our balance sheet. Under assets, we would have, hopefully they'll spell it correctly on our balance sheet, unlike I just did. We'll have our inventory, and it will be at that. So going into the next period, this would be the beginning inventory that we would still have on the books. And this would also be in the beginning inventory, although it would be two different layers. But this would be the ones that we would sell first. First in, first out. So we'll sell these 35 units first, and then go to the 50, and whatever purchase we have next, next time is, we'll go in there too. But this is, we still have 35 left that we have to sell before we sell any of these, because these came in before those did. Any questions on that? Okay, now this is the first time you guys have seen this, so it's a little bit confusing. It's understandable. But the whole reason why we have to do this, though, is going too far. The whole reason why you have to do this, though, is because we have these at different costs. This is why it's hard to say exactly how profitable a company is, and especially when it comes to cost. I know it sounds odd, but sometimes people say, "Well, just what does it cost?" It's hard to say. You gotta, Okay, let's go to page 4. What time is it? This will be the last one we do. Okay, so page 4. Well, easy. You want to do the sales. So we sold 90. $35. Okay, 90 times 3,150. Is that right? That's not right. Let me know. I'll put the correct one in. Okay. So these are the sales. And that's the easy part. We'll come down here and we need okay, we need the cost for 90. So here I'm going to So we sold 90 units, we need a cost for 90 units. Okay, so where are we going to go first? Which were the first ones in? The first ones in were the first ones we sold. Yep. Yep, Abigail, that's right. So it'll be on 1-1. So we're going to take, this is our first, the first ones we sold. Now notice, we can't get all 90 out of that first, there's only 40 in it. So we will take 1-1. Okay, so we can take 40 from 1-1. But we still need the cost for how many?
We would need 50 more.
Yep.
And we would get that from 113.
Yep. Yep. Correct. So this, we still need 50. And so we have to go. Now, notice what's happened here, though. The strike through up here somewhere. I think they're right there. Well, it's not a very good strike through, but maybe I'll do it like this. There we go. That inventory is gone. And it's never coming back. Okay, so that's gone. So we still need inventory. From 113. And we can get all 50 from there, right? Yeah. Oops. Notice we don't need all 60, we just need 50 of it. Right. I don't need to put this in, but okay, so we can get it from those two layers. Now we don't have 60 in here anymore. How much do we have in this layer?
We would have 10 remaining.
Yes, exactly. All right, so these, I don't know how to do this. So these would be the ending inventory amounts. And these would be the prices. Oh. We're carried away there. So this is kind of, this is what's left over. And again, this first one is never coming back. And neither are these 50. You know, these 50, there's only 10 in there. Those are gone too. Okay, so let's see what our cost would be. Let me do that. How they worded it on the last one. Okay. Okay, so We sold 90 units. We got the cost from the inventory. 1/1, which was 40. Let's put a minus there. And we also got the cost for inventory. 1/10. So notice that we found there's a way to do this. I'll do it like that. You know, we found all the costs for all 50 of them. Why doesn't this line up? Okay, there we go. Okay, and so price each, cost each, let's say. And the cost each was 15 for the 40. And 20 for the 50. Oops. Yeah, if I shouldn't. So it costs 15 each for the 40. And for the 50, $20. Okay. So multiply those out. I know what it is. You know what it is? There's a blank a space in each one of these things. So if you go in front or behind it, that's why it comes out strange. See, I'm learning. Should know this, but I might have mentioned that. Okay, so 40 times 15 equals 600. Well, I certainly learned something today. Okay, and then 50 times 1,000. You just beeped at me. And so this will be our cost of goods sold. Add those two together, 1,600. So this is going to be your cost of goods sold. So we took the first ones in. We assumed the first ones in were the first ones sold. This is probably the way most businesses work. This first in, first out is probably the closest to what actually happens in a business. And not to get too theoretical on here or anything like that, but quite honestly, if you're on January 3rd, there's no way you sold inventory from this layer on the 21st. They weren't even in the building at that point. Right, so you know, usually the first one's in and the first one's sold. So if you sold something on January 3rd, it's not going to be from either of these layers. They weren't even there yet. Okay, gross profit. Sales, 3,150. Cost of goods sold. Probably called COGS. You can put it as COGS. That's fine. I'll abbreviate it. Hey, doesn't fit this time. So I got rid of my COGS. So cost of goods sold was 1,600. Yeah, with the minus in front of it. And so 3,150. 1,550. And let's do the gross profit. Okay. So there is our gross profit. And again, you know, it matters which ones we sold. Will make a difference on our gross profit. I am going to cut and paste this down to our end here so that we can. It's just easier. You don't have to do this, obviously. Just doing it so I can put it on the screen. Let's put it here. Okay, so our ending inventory will be, so inventory, you don't need to put this in, but inventory on 1/1. In fact, I shouldn't put it in all. It's 0. There's nothing left there. I'll put it in. I got to add a row then. Man, knucklehead made this. All right, so this is. Let me show you. Look, let me get my act together in a second here. So this is. You don't need to put this first layer in, but this is 0 times cost each is 15. So we no longer have anything in this beginning inventory. It's gone. It's never coming back. Our inventory on 113. How many units we still have left in our inventory on 113?
10 units.
Yep. 10 at 20. Is that 200? I think. It should be dollars. And by the way, one of the things is different about inventory than a lot of other things is there's actually 2 things going on. There's a quantity and a cost. So you'll have units, but then you'll also have costs that go with those units. So there's actually 2 things that can go into the final total for the inventory. Inventory on 121, we didn't use any of that. So we're still 70. Some amount. right, so 70. 1750. Uh, 1950, right? And so this will be our ending inventory. Oops. So there's nothing left in beginning inventory. It was all sold. We sold 50 of the 60 here. So only 10 left. And we didn't sell any of the 70. So these are the only ones that are still left standing. Now, when we go into February and start selling, these are going to be the first sold in February. These are going to be the next ones that are sold in February, and then whatever we purchase in February will be last. Okay, well, that's probably enough. I know I'm over by 3 minutes here, but that's so we'll save page 5. For next time. So this is LIFO, LIFO FIFO stuff, and it's a little bit tricky. You really got to keep the layers of inventory, and the problem is the cost. The cost is the most difficult thing, probably in accounting. To be honest with you, I mean, especially if you're running a retail business, what does something cost? The sales are easy. Whatever they paid you. This is how much cash they gave us. Okay, fine, 31.50. So this was really easy to get the sales usually. It's this inventory that's the problem.
Yeah, I think the key is to just like always remember, like, first in, first sold, last in, last out. So that, because if you mix it up, I feel like you just ruin the entire thing. Like you can mess it up.
Yeah, and you got to be careful too. The way the book shows it sometimes is that they'll, the way I showed you is actually the method of what is actually first in is the first one sold. You'll notice something. The ending inventory will be the last in, right? The last ones that were in, right? I mean, if the beginning, if the sales were the first ones were sold, the ending they're going to be the last ones that you got in. So sometimes the books will show going backwards. They'll use the last one. It can be very confusing. The way I'm showing you though is exactly how it's theoretically done. So if you just keep track, yeah, you're right, absolutely right. Keeping track of which ones were the first ones in, which ones were sold, and just sticking to what the methods are, which ones were sold. So yeah, yeah, this can be it can be tricky. And by the way, if this is confusing, it should be first time you've probably seen this, so you're not alone if this if this is a little bit confusing right now. We're gonna do more of it though. So we'll go ahead and we'll stop right there. Any questions on this?
No, thank you for class, Professor.
Okay. All right. Well, if you have any questions, you can feel free to contact me and we can do all this stuff. All right. Nothing due for next class. Wait a minute. Is there a? I think the test is due. The test isn't due till Friday, I think, right?
I believe so.
Yeah. All right. So chapter 3 is due Friday. If you have anything to turn in, make sure you turn it in. Don't worry about it showing up as being late. I don't take off for that. But so anything you turn in will be full credit. And any questions? Okay. All right. Well, I will talk to you guys on Thursday. We'll pick up on this cost of goods sold. And again,
Sounds good, Professor.
we're skipping chapter 5. Okay, guys, have a good day.
Thank
Thank
you.
you.
Have a good one.
Thanks, guys.
Yeah, I should have all the handouts like from the book Thursday in because I think I might just battle book again because they not really trying to help.
Oh, you contacted them? What did they say?
Yeah, I called. They act like they didn't know what I was talking about.
Really?
Yeah. I didn't say anything in the email though. I just said my name and all that.
Okay.
Did I supposed to get them like the little number that like
Well, yeah, I would say I give them at least your email address, and that you refer from Roosevelt. You know, they might do it by school. I'm not sure.
okay.
Certainly, it's kind of crazy. Certainly, would think. I guess they do it for security reasons, but ideally, you'd be able to look it up using your email address.
Okay.
You know what I mean? You know, that they would have a record of it, that this code was sent to this email address. It was linked to this email address.
Yeah, that's what I said, but
Yeah.
I'm gonna try to call again. I'm gonna try to call again.
Yeah. If you can, I mean, it's pretty expensive to do to buy it again. I don't know. It's crazy expensive. It's crazy expensive to buy it once. So
Yeah.
Buying it more than once is obviously not a good thing. If you still don't get a response, let me know, and I'll see if I can. I'll see if I can. I'm not sure if I can get anything done with it, but I'll try to send it to our. I did send it to the rep, and he was one that forwarded it. But let me send something to our department chair. If it doesn't come through, do me a favor, and again, to try to get a hold of them and see what they say.
Okay.
And if they aren't cooperative, or they're not doing anything, then let me know, and I'll get a hold of our rep directly and see if they can do it. All right. Yeah, don't buy it again though.
Okay.
All right. All right.
I thank you.
Thanks. See ya.